Hey guys, welcome to the channel. Welcome back to another live. Appreciate you guys being here. We're going to have a conversation today about layoffs, the debt ceiling, inflation, and what this means to you as investors. Sort of my note to investors, okay? So on today's live, let's have the conversation. I'm going to start off by giving you a quick stock tip, talk about something that's happening in the stock market that you need to know about. Then I'm going to give you a little bit of information about the debt ceiling because I read an article that I want to share with you guys today. It just came out today. And then I want to talk about a little bit about unemployment, where we are in terms of layoffs that I've been seeing happening. And then I want to give you a note to my investors towards the end of the live, or towards the end half of the live, right? So I appreciate you being here. As you come in here, guys, do me a favor and hit the like button. Do me a favor. And also, if you're new to the channel, please consider subscribing to the channel. And also check out the link, the description box below. We got a lot of stuff down there. We'll talk about that later. But I want to start off with a stock tip. Now, listen, I ran across this and I wanted to share it with you guys. I'm not a huge individual stock person. I'm an ETF guy and an index fund guy. But when I see something that I think is important and may be important to investors, regular retail investors like we are, I just like to alert you guys that, right? So I want to show you something real quick. It's an article I came about yesterday. I think I came across yesterday. And so let me share my screen with you if I can find the article. Give me just a moment as you guys come in here. Thank you so much for being here, by the way. I definitely appreciate you being here. Let's see here. I'm going to try to find the article. Give me a moment. Let's see here. There it is right there. Okay, so I'm sharing my screen with you. If you're not on here and able to see my screen, guys, just know that I'm sharing my screen with you guys. Quick stock tip to get us jumped off and started on this live. Okay, so let me find it again. I lost it, but I think I got it back. There it is. Nope, that's not it. Where's it at? I'm looking for it. Bear with me, guys. There it is right there. Okay, so here's the quick stock tip of the day, okay, of the hour, I should say. We're going to kick it off with this little bit of stock tip right here, okay? Warren Buffett finally reveals, and this was an article that came out yesterday. Buffett finally reveals the mysterious company he's been investing billions of dollars in, right? And I think he started this back last year sometime. So the mystery is over. Warren Buffett of Berkshire Hathaway disclosed a major stake in the insurance company Chubb. That's my stock tip of the day. Chubb Insurance. It's an insurance firm. Now, I have not done my research on their K10s, K9s, and all, or their 10Qs and all that good stuff. I haven't done my research on all that, their profit loss, etc. But this is what Buffett has been investing in. Said Berkshire revealed it's acquired nearly 26 million shares of Chubb in a Wednesday securities SEC filing of the company's first quarter investments. That translates to a value of about 6.7 billion. Buffett's company had shielded this position from public knowledge as it was building stake. So they didn't say they were investing in a Chubb Insurance until until just recently. Chubb, an insurance business that operates in 54 countries, made headlines in March after the company underwrote President Donald Trump's nearly $92 million appeal bond, right? So Buffett, Berkshire CEO, famous for his investing prowess, has amassed a sizable following of investors who mimic his portfolio, right? Berkshire's stake in Chubb is no exception. Chubb's stock jumped by more than 8% in after-hours trading on Wednesday. So Buffett has been investing in Chubb since late last year, I think third quarter of last year, second half of last year, and kind of kept that under wraps. But as soon as it opened up and it became known that he was doing that, the Chubb Insurance went ballistic. It went up, a sharp up, just by this one company called Berkshire revealing that they had been investing in Chubb. Pretty interesting, right? Think about that for a second. Let me stop sharing. I want to share something else with you guys. I'm going to show you something real quick because I like to share this information, guys, as we talk about this stuff. We're just regular average investors, but we got to know what's going on around us. Let me show you Chubb stock real quick. This is on Yahoo Finance. Here's Chubb. And let me see if I can blow that up for you. Here's Chubb right here. Okay. Chubb, 2.6 trading at what they end the day at 265. But look at what happened to Chubb over the last, let's say the last year, let's say the last 1 year, total 1 year. So back in July, August, September, when Warren Buffett started investing in Chubb, look where they were. They were trading at what? Buck 89, buck 99, buck 90. Now today they're trading at 265, 264.75 is what they ended the day at. So again, I'm not a big individual investing guy, individual stocks, right? I like ETFs, I like index funds, but when you start looking at this stuff and understanding that at this point, look what happened just yesterday, right? Look what happened just yesterday, how the stock went up. It shot up like a rocket from 255 or 252 up to 264 is where it's at, up what, nearly $12 in 1 day. So this is what happens with these larger investors. I just want to bring this information to you. A little bit of note to the investors, the retail investors. Now, listen, none of us thought about Chubb or knew about Chubb way back here when Warren Buffett started investing in it, right? But lo and behold, now everybody has sort of mimicked what he's doing, right? So let me get that back off the screen, stop sharing real quick. So I say all that to say this to my regular, average, everyday investors. They call that investing style coattail investing. When regular investors like me and you follow and watch what the big boys are doing, the big boys being the Warren Buffetts, the George Soros, the John Paulson, right? These big time celebrity and they're sort of celebrity investors. When there's people whose whole strategy for investing is based off what those guys are doing with their money. And that's called coattail investing. And it's what a lot of people do because they've seen what Berkshire Hathaway has done over the last 20, 30, 40 years. And they say, wow, if you look at a chart and see and compare what Warren Buffett, his company has done against the S&P 500, it's no comparison. He's destroyed the S&P 500, right? And so people do that coattail investing by just grabbing onto what the big boys do. The big boys are buying that, I'm buying that, right? People know that Berkshire Hathaway is a big blue chip company. But here's the kicker. By the time great stock information gets to me and you, like we just got this information about Chubb yesterday, dude has already made billions of dollars in stock. I mean, in the increase, right? He invested billions, made billions, and now we just now as retail investors get to know about it, right? Because it just got reported in CNN or something like that. But just something to think about. I just want to share that information with you guys because sometimes on here, I like to just give you that little bit of stock tip for you to be thinking about. Coattail investing, coattail. Do your own research, guys. As you come in here, let me know you can hear me. Also, do me a favor, let me know where you're stepping in here from, guys. I'd like to know. Robert's in New York City. Good to have you, Robert. Mrs. Moore, thank you for being here, Mrs. Moore, from Atlanta. Robert said he's in tech. My job is a mess, hoping it doesn't crater yet. We'll talk about that real briefly here a little bit later, Robert, and look at some of the layoffs that are happening that I think you guys need to be aware of also. Art of War, checking in from Ohio. Thanks for smashing that like button. I really appreciate that. Blue Sky, peace and prosperity to you all, to you as well, Blue Sky. Let's see. Thanks for the thumbs up. Let's see. Show Bitcoin chart for the last 15 years. Okay. That Bitcoin chart for the last 15 years is going to be almost straight up. There's going to be some dips and problems in there as well, but we know it's going to look good. Kathy, good to have you in here. Let's see here. Yeah, late to the party. We didn't get an invite. Absolutely. If you go on to read that article, it talks about how, Berkshire purposely didn't disclose this information. Well, why do you think that is, right? There's probably several reasons, but one of the main reasons is to make sure that they can get in there, solidify a strong position, and then reveal the information to the public because they know they have coattail investors out there. And if they announce something, it's going to bring the price up like it did with Chubb Insurance. But There's a lot of listen, if you listen, we talked about 2 weeks ago about the insurance industry charging insurance prices going way up for auto insurance, for home insurance, because the price of repairs and so forth have gone way up. Products and things that they have to use to make the repairs and so forth have all gone up. So insurance has all gone up. So what's that mean for insurance stocks? Right? This is how you got to be thinking as an investor. The things that most people look at as problems and issues, and oh my gosh, you as an investor got to start looking and saying, okay, wait, how can I profit off that as an investor? Right? How can I not get late to the party, but how can I get to the party a little early by seeing, oh, okay, so that's what's happening. Yeah, boom. Okay, let me start to invest. Maybe there's an ETF out there that you got that you like, or an index fund that focuses on, somewhere in the insurance industry. The point is, take advantage as investors of these issues and problems that you see, which is what Warren Buffett does with Berkshire Hathaway. And listen, I'm not saying anybody can be a Warren Buffett because they can't, right? Kenny's in Chicago. Good to have you here. Winnipeg, Canada. Arizona checking in. Good to have you. LA, Los Angeles, California is here. And Laveen, Arizona. Yeah, Chubby. It's not Chubb, it's Chubby. Clint Perry. But yeah, you're right. A lot of folks. Well, Chubb Insurance has been around for a long, long time. I heard of them a long time ago. But the kicker is, I just want to try to bring that to you guys in case you weren't thinking about it, right? Let's see here. Let's start with the debt ceiling. Let's talk about the debt ceiling because the debt ceiling kind of made the news today, right? Let me go ahead and remove that. And if you haven't, guys, you can always check me out at smartmoneybro.com. Let me get that off there. Okay, so let's talk about the debt ceiling. Okay, the debt ceiling and what's happening with it. There was an article came out today, and I wanted to share it with you guys. I'll do that in a moment. But I did a video live on here about a year and a half ago. Debt ceiling was at about 31 trillion, 32 trillion, right? It was right before the beginning of last summer, last June, when there was this big problem with the debt ceiling, right? Democrats versus Republicans, Republicans versus Democrats. We got to get this thing figured out. It was around 31, 32 trillion. Well, it's at about 34 trillion now. The debt ceiling is at about 34 trillion, the debt that America owes. Let me share my screen again. I want to show you something interesting. If you guys don't know about this website, you can always go to it. Let's see here. U.S. national debt. Where's that at? Here it is right here. Check out that, guys. Isn't that interesting? That should give you a good idea what's happening with the U.S. debt right now as we speak. Look in the upper left-hand corner is really the big one that makes the U.S. national debt right here is ticking, moving up as we speak. Debt per citizen, $103,183. That's per citizen, right? U.S. spending, $6 trillion. U.S. federal budget deficit, but this is the big number over here. Let me stop sharing this one because there's another one that's a little easier to read. That one's like there's numbers all over your face, right? But there's another one I want to show you that's a little bit easier and simpler to read. Give me a second here. I'll bring that one up. And so let's see here. It's going to be that. Boom, boom. There it is right there. Right there, 34 trillion. Somebody said, what is the national debt today? And that's a running clock as well. It doesn't have all those other numbers on there, but $34 trillion and counting, right? Like when you get right here, that's the hundreds. I think that's the 100,000. I think that's the 100 millions. That's the billions right here. 34 is this 4 is the trillion. I think that's 13 numbers over. $34 trillion. And this says 102, folks. Maybe it's not updated. Let me see if I can refresh it if it helps anything. This one says $102,000 per U.S. citizen for every single human being in America. It's only getting worse. It's only getting worse, right? It's only getting worse. And we think about this, guys, and we say, well, we don't care about the debt ceiling. The debt ceiling that's going to be a huge issue, right? Let's see here. Going back to the chat. Guys, if you have a question, make sure you put a Q in the chat and I will try to get to it. I really will. Let's see here. Just going through the chat here. There's insider information that we 99% don't have. Yeah, we're just retail investors, guys. For you investors out there, and understand we are just retail investors at the bottom of the whole realm. Institutional investors come way before us, right? So just understand that and know that the US debt is crazy. Is it insane? It's more than insane. It's I don't quite understand it. Those are numbers that I don't think anybody can really wrap their head around if you look at that, guys. I mean, and it's only getting worse. America is running a deficit at 1 to 3, somewhere around there, depending on where you look and read. $1 to $3 trillion a year, America is running a deficit, meaning that we're spending more than we're bringing in. And it's like, I don't care if you're Republican or you're Democrat, no matter what side of the aisle you're on, both of them are doing the same thing, right? They're both running the thing up and just not caring about, what's next or what's going to happen. And with this, it sounds cliche-ish when we talk about, well, what's going to happen with our children? They're going to inherit, our grandchildren are going to inherit the debt. They will. And it may sound cliche-ish, but it's something that we should be thinking about at some point and saying, how do we do, or what do we do, or what can we do? What can the problem? And this is what happens a lot of times, guys, is the problem is that, hey, as soon as you get a politician in there that wants to cut from some area, the first thing that happens is people on the other side of the aisle say, wait a minute, you can't cut that. You hate the American people. You don't like the American people. You're trying to cut this, or you're trying to cut that. You can't cut that. You're going to hurt this person, or you're going to hurt this program. Well, listen, somebody got to hurt if you're talking about addressing the budget, the national debt, right? Somebody is going to be hurting somewhere. So if you really want to address this, as opposed to just printing money, right? If you really want to address this, then somebody's going to be hurting. Somebody's going to take a hit. Somebody is going to be mad. Somebody's going to be angry. Somebody is going to be highly offended, right? But of course, we live in a society today where if you offend anybody, oh my gosh, it's time to take this person's job. It's time to what do you call it? Cancel that person because they should not be thinking like that or saying or whatever. It could be anything. The point is that somebody is going to have to be hurting. I don't know if it's going to be a social program or not a social program. I really don't know, right? But I do know that something's going to have to give as we look at this. Let me run through this real quick. Let me show this to you guys since I'm in the mood for showing articles, right? Let's see here. If I can find it. Let me show you what came out today. It just came out today, actually. Yeah, today. Today is the 16th. Let me share this one with you guys real quick here. Let's see. Boom, boom. Let's see here, right here. I'll share this quick article with you guys. So, quick article came out today. Article says, and I'll kind of run through it with it and paraphrase it for you. Billionaires Jamie Dimon and Ray Dalio sound the alarm on soaring U.S. government debt. The chorus of voices warning about the dangers of record U.S. government debt is growing louder and louder. It didn't say and louder. I added that. In the past 24 hours, J.P. Morgan CPO and Ray Dalio, the founder of the world's biggest hedge fund, have weighed in with concerns about America's debt pile. And I'll just go back here. The sooner we focus on it, the better, Dimon added. At one point, it'll cause a problem. Yeah, duh. Yeah, it will cause a problem. The problem will be caused by the market. And then you'll be forced to deal with it. And probably in a far more uncomfortable way if you dealt with it to start. Just like I said, somebody's going to hurt. If so, you might as well hurt now as opposed to hurting when you gotta hurt, and then it's going to be a much, much worse. That's my opinion. Apparently, I agree with Jamie Dimon, and he agrees with me. Yawning deficits are adding to the overall level of U.S. government debt because they require the Treasury to issue more and more bonds. Dalio said he was anxious about waning investor appetite for the government bond known as Treasury. And he goes on to say the comments by the article goes on to say the comments by Dimon and Dalio reflect widespread concerns about the broader risk of the huge U.S. government debt burden, which the Treasury Department puts at 34.6 And if we looked at our deal we just had up, it's at 34.5, but it's right there at 6. It'll be at 6 in the next day or two or week or two, what have you. So it's an issue. It's a problem. Last month, it says the IMF said the high and rising level of U.S. government debt risked driving up borrowing costs around the world and undermining global financial stability, right? The warning followed an even blunter message from the head of the CBO, the U.S. Congress, the independent fiscal watchdog, who said the U.S. risked a bond market crisis of the kind that engulfed the UK under former prime minister. So what, what can happen? What should give? Who should hurt first, right? Then, hey, I know the debt ceiling sticks around all the time, just chilling in the background. The U.S. government, this whole debt ceiling issue is always kind of under the radar. It doesn't come to the radar until we need to bump up the debt ceiling like it did last summer, right? But the U.S. government always allows itself to borrow more money by raising the debt ceiling like we did last summer, right? Up. Can't borrow no more money. Can't borrow no more money. Let's just raise the ceiling by $2 trillion. No big deal. Go print some money. Where we good? So when the Congress allows the debt ceiling to be raised, that allows the federal government just to go out and borrow more, right? The debt ceiling is a law. If you didn't know, the debt ceiling is a law. Congress makes laws. It's a law that limits the total amount of money the government can borrow to pay its bills. That's all it is. It's a limit by the Congress. Right now, the debt ceiling has never not been raised, right? With all this fanfare and people talking about it, every time this issue comes up, they raise the debt ceiling, right? So if the debt ceiling wasn't raised, it would be new territory and the consequences would be rough. So before we get to that point, why not address it? If the government can't pay its bills, guys, then it can't pay things like, I don't know, salary for federal employees, right? That's about 2.5, 3 million people. If the government doesn't raise its debt ceiling, it can't pay the salary for people in the military. It can't pay for pensions, right? It can't pay for, Social Security and Medicare, right? I'm just giving you an idea of what could happen. I mean, paying people that receive food subsidies like SNAP, right? Interest, it can't pay interest on the national debt, right? It can't pay the interest on the bonds that the government has issued to individuals and institutional investors and other countries, right? Because that's, so you guys know, and I know a lot of you know this stuff, right? But a U.S. Treasury bond is just a loan from somebody else or some other government who bought the bond from the U.S. and now the government has to pay back that bond, has to pay that back at maturity, right? So the U.S. has to pay the interest back to those bondholders. And if the government somehow doesn't raise the debt ceiling and can't pay interest back to those bondholders, and some of those bondholders are not like me and you, these are like institutional bondholders, right? Whole countries, right? That buy America's debt, right? Government could default, but the government's never defaulted, right? So like the beginning of last year, the ceiling limit was breached, right? Went over. But the U.S. Department of Treasury, they issued some type of extraordinary measures, right? And we went 6 more months, and that's why in June of last year, we had that big issue. And it'll come up again here shortly, right? But there's also people out there about the debt ceiling that say, hey, we need to just get rid of the law on the books that say there is a debt ceiling because it really doesn't serve any purpose if we constantly keep moving the debt ceiling up every single time. All right? Because it always gets raised. The debt ceiling has never not been raised. So it defeats the purpose. Maybe we shouldn't even have a debt ceiling, is what some people say, right? So some Congress folks says, hey, control your spending, government. And the Congress people that come out and say, control your spending, government, and here's how we're going to control it. We're going to cut this. Those are the Congress people that when you turn on the news, they're the ones that's being talked about by the other side of the aisle, whether it's, I don't care which side of the aisle, because it happens both ways, but they're the ones that are being talked about and said, you don't like the government. You don't like the people. You don't like the American people because you're trying to take away this program. You're trying to take away that program. And because you don't want to, you voted against raising the debt ceiling. It's political. It becomes political, right? So that's why it's really, really tough. I don't care what side of the aisle that you're on in Congress. It becomes hard for that person or that congressperson to say, let's hold off on this and let's take a more responsible look at this so we can cut the debt ceiling, right? As you know, no matter if you're Democrat, Republican, that type of let's cut the debt, let's cut our spending, that type of attitude don't get you many votes. And typically you cave in and the debt ceiling always gets raised, right? So what does it mean for us? Don't panic. I know 34 trillion sounds like it is incredible, right? But don't get yourself all worked up over it. Stick with your plan, but pay attention to what's happening and what's going on. This is an election year in America. And I think I read more than 60% of the countries across the world, 2024 is an election year for those countries. 60%, more than ever before in recorded history this year. So it's a big year all the way around. And these issues that we're talking about, debt ceiling and all that, they're not just America. These are issues that really are all across the board in many countries. So, hey, are you voting your party or are you voting on the issues? Are you voting on your economic well-being? These are decisions that you have to make. And these are things I want you guys to be thinking about as investors, as consumers, being aware, right? But as an investor, don't panic. Don't get too high. Don't get too low. Find your sweet spot and stay there. Relax. Listen, you don't own all the problems of the world, so don't get all huffy and puffy about all the problems. But at least know what's going on, right? Let's see here. Let me go back to the chat, guys. Clint said, let's see, Moreno Valley, California is in here. Let's see. We need to stop government spending and turn it around. Yes, Clint said we need to stop government spending and turn it around. Well, what do you cut if you stop government spending? That's the $100,000 question is what do you cut, right? Let's see here. Somebody said, how realistic is cutting into our debt, and be specific as to what has to happen in order to cut it? Something's got to cut. Do we want to cut defense spending? I don't know. Do we want to cut some of the social programs? I don't know. Do we want to cut some of there has to be listen, I'm not sitting in Congress, so I don't know I haven't thought about it that deep, but I guess if I think about it that deep, I know that some things will have to be cut. And we'd have to make some hard decisions, right? How realistic? It's realistic if they really want to focus on it. I think it's realistic. Let's see. Somebody says, do I buy meme stocks? No, I don't buy meme stocks. I think that says stocks. Spending millions on monarch butterflies in France. Let's see. U.S. is just maxing out their debt credit card. Pretty much. Somebody call Dave Ramsey so he can get them together. Who knows? Yeah, good point. So let me shift the conversation just a little bit, guys, to talk about layoffs. I was reading an article today, and I wanted to bring this to you guys' attention as well. Yes. The labor market is still fairly tight. And I say fairly tight because we are seeing a slowdown of new jobs a little bit, right? But at the same time, the overall American labor market, the unemployment rate at the last reading from the Bureau of Labor Statistics was right around 3.9%, right? So, and it's been hovering there, 3.9% for the last several months. So for the last several months, right? Before that, if we were talking last year at this time, we were around 3.4, 3.5, 3.6. Now we're at about 3.9, right? Still tight, still very low, but at the same time, we got to start thinking about, is this a trend upwards for the unemployment rate? Is it a trend to 4%? Is it a trend for 4.5%? We're going to see shortly, but that's something to consider as well. And I want to share something with you guys as well. I don't know if I share it with you, but I was looking through several articles, and there has been some layoffs recently. Actually, the first one that I came across was an article from today, or was it today or yesterday? Talked about a few firms, right? Spirit Aero Systems laying off 450 workers out of Wichita, Kansas. Walmart laying off and relocating hundreds of corporate workers. Not to alarm you, but just some things to think about. IBM laying off some workers as well. BuzzFeed, Nike, Salesforce, Microsoft, a few of them, Google, a few of them, right? Sports Illustrated. Now, you may be saying this is not new. Companies lay off people all the time. Correct. Correct. Nike laid off 700 plus people in April this year. Southwest Airlines laid off 2,000 people. This happens. It's not anything new. It's just business doing business, right? Tesla has laid off what 6 or 7,000 people as well. I think I read, right? And let me see. I got a list somewhere. If I can find a list, maybe I would share it with you guys. But there's a lot of companies that are starting to do a little bit of layoffs. Now, not anything to get overly alarmed about, but just to have that conversation that as a what northern here it is Northrop Grumman they got the government contract, huge government contract. Expedia, Continental AG, Cisco Systems laid off about 4,000 folks back in February. And it goes on and on and on, right? Big long list that I could continue to rattle off of companies. Not super duper unusual, but something to think about, right? Something to think about. Peloton, you knew they were going to be laying off people, right? But so as a regular worker, and this is why you want to make sure that you, as a regular American citizen, consumer, investor, that you have emergency money, right? I think I just released a video talking about emergency money, right? And what to do once you pay off your debt, right? I think I did a video yesterday, matter of fact, a live yesterday about life after debt. Once you pay off debt, do this. Very important, guys. I cannot stress it enough. You got to have some emergency money. But yeah, the unemployment rate has been tight. Labor market has been really tight. I don't think we've seen over 4% unemployment rate since maybe 2 years ago, maybe 2.5 years ago. The last time we saw 4% unemployment rate, right? I mean, that's very, very good. That's a very tight labor market, right? Meaning that there's lots of jobs. But as the Fed chair came out and said on his last address a week ago, he said that that market is starting to come into more of a balance where supply and demand of labor is starting to equal out a little bit. Well, we know what that means. Well, if you don't know what that means, when labor supply and demand start to equal out, we see a little uptick in the unemployment rate, right? And so we've seen that. We've seen that in the last 6 months or so from 3.4, 3.5, 3.6%. Now we're at 3.9% and maybe moving higher. So this means that it becomes very, very important for you as a consumer to actually have some emergency money in case you are the victim of being laid off or your job closes up ranks or your position is moved on from, right? It happens. It happens. And how are you going to feed yourself for 6 months? How are you going to feed yourself for 3 months? Have a little bit of emergency money. You don't have to panic, right? When you have emergency money sitting to the side as an investor, you don't have to panic when things are going haywire or the unemployment rate goes from 3.9% to 4.8%. You don't have to panic because you got money to sustain yourself if something goes wrong. And I can't stress that enough on this channel. You got to have that additional money, right? Yeah, layoffs are ticking up just slowly, ever so slowly, almost unnoticeable by a lot of people, right? All really unnoticeable until it hits home. You got a friend that got laid off. You got a neighbor that got laid off, or you got laid off, right? They're ticking up slowly. Let's see. I'm going to highlight that question. Somebody said, if some groups are talking about foregoing the national debt altogether, wouldn't that set a bad precedent? Yeah, it could set a bad precedent. It could also look bad to the folks that do the ratings, right? your Standard and Poor's and so forth. So every single country across the world, they get their credit rating just like me and you get a credit rating. We got those three bureaus, right? The Equifax, Experian, whatever. Well, there's ratings for countries, right? And last year we saw a dip in one of our ratings from, I think it was Moody's or somebody. They lowered the rating for America based on all of this debt ceiling talk and controversy and friction that was going on. They lowered one of our potential ratings, right? Moody's did. But the point is this: it looks bad to the world when America can't control its debt and its debt spending. So what ultimately happens, guys, is, remember we said that America sells bonds to help pay for its stuff, sells bonds that they have to be able to pay back. Well, I don't know if I said it on this live or not, but when that looks like or looks in jeopardy, it looks bad for our credit rating, right? To the companies that rate countries' credit. So it's not a good look overall. Let me scroll back because I think I saw yes, a super chat. Thank you so much. I had to pick that up. So let me go here. Give me a second here. And so I hope that answered that question, but I got to recognize the super chat. Blue Sky, thank you so much for that super chat. The Blue Sky said, I have recommended your channel to my teens. Thanks for the info. You got it, Blue Sky. Anytime. I appreciate that. Thank you for recommending the channel to the teens. And frankly, if you're a young person, 20, 21, 19, 18, 21, 22, this is good information, right? So I appreciate that super chat. Thanks so much, Blue Sky. I didn't mean to pass it up. Let's see here. Let me go back to where I was. Boom, boom, boom. Somebody said, I remember during the Tucker Carlson interview with Putin mentioned how the U.S. should be more concerned with our borders and debt. Yeah, that did happen. Absolutely. And there may be some validity to that, unfortunately. Let's see. Hi, scientists here. Good to have you here. Antarctica? Are you really checking in from Antarctica? Let me know if that's true or not. I just been reading on some stuff about Antarctica, by the way. Nobody owns Antarctica. I just learned. I'm a big history buff. So nobody owns Antarctica. Back in the 50s, every country signed a treaty to leave Antarctica alone for research, by the way, in case you guys didn't know. Let's see. Fed would like a higher unemployment rate. Good point. Fed would like a higher unemployment rate. Yes, the Fed wants maximum employment and price stability. That's their two mantras, right? Maximum employment and and price stability. Maximum employment does not mean they want everybody working. That's not what it means at all, right? Sounds like it, but it's not what it means at all. It's kind of a wordplay. Somebody said, this person said, Biden administration will do everything to prevent that. Absolutely. In an election year, you cannot, if you're the incumbent, you cannot allow unemployment to go up. My goodness, are you kidding me? They won't even let the price of gas go up in an election year, right? If the gas starts going up, guess what's going to happen again? This happened 2 years ago when the price of gas was going up, and it was an election year, not for president election, but for Congress. Right around October, November, the president went in and got the SPRs, right? The SPRs is our petroleum reserves in America. They open up the petroleum reserves that are sitting down there in Louisiana and all that area, southern Louisiana, southern East Texas, whatever. And they went into the preserves and pulled them out and sold them on the market. In other words, decreasing the price of gasoline. That was just the Congress elections a couple of years ago. So those things happen in an election year. That's why this all kind of plays into a political thing as well. So I don't know what your take is on that, but that does happen. Let's see here. Antarctica. Yeah, that's crazy. Antarctica. If we got somebody in Antarctica here, I definitely want to know. Hey, London, England here. Good to have you. Let's see here. Pay your bills. Let's see. We as a nation need to address our national debt. My question to you guys in the chat right here is, how do you address the national debt? Right? How do you address it? That's the question. So we're talking about the debt. Something's got to give when it comes to the national debt. What gives? Right? What's the solution? We don't know. Maybe we could know. I don't know. Right? But back to layoffs. As for investors, make sure you have some money put to the side, guys. Please, please, please have some money put to the side. Let me fix something real quick here. Give me a second. Boom, boom, bada bang, bada bang. So, for us as investors, guys, let me say this. We know the US economy has seemed to be fairly resilient so far, but something is kind of brewing, and what is brewing could make a difference. And I want to just real quickly mention this because this could make a difference. Let me see. Let me go to the chat before I talk about this. This administration keeps changing the measurement standards for CPI, recession, and now unemployment or employment. My point is to be prepared, as you're saying, the real numbers are unknown. Could be, right? Could be the way that the numbers are given to the public. And listen, if you know anything about numbers, anybody in the chat, if you know anything about numbers, anything at all about numbers, you know that numbers can be manipulated. And numbers can be manipulated and reported on to say whatever you want it to say, right? You could do that with your own budget, right? When you're dealing with numbers, you can make the numbers look and say what you want them to say in order to put out a particular narrative. Understood, right? You got to be thinking, right? And we are thinkers on this channel. We're all about making sure that we look a little deeper than what's being said. So, what that point you made there, Steve, is important, right? It's important what you said. So I appreciate you adding that comment. Jody's in Houston. There has been a series of layoff of teachers. Yes, I heard about that as well. And others who work in the educational sector. Just imagine that, right? A place where you thought you would always have a job in education. But yeah, that's a good point as well. Thanks for mentioning that, Jody, in the chat. Smart Money Bro, from your observations, do you think the Fed will cut rates soon or even this year at all? No, I don't think the Fed is going to cut rates. And if they do cut rates, it'll be at the end of the year. Well, it'll be September. That's my opinion. And I think right now, if I remember right from what I read, the stock market has priced in a 30% chance. I could be wrong about that, but I think around a 30% chance that the Fed will cut rates in September. Remember, this is the important thing we also got to remember is that oftentimes the the outlooks that we get in the news is often wrong. Think back to 2023, 2022. We're going to have a recession. We're going to have a recession. The market, we're going to, okay. And, what do you call it? Inflation went way high and we was like, oh my goodness, inflation's way up. What's going to happen? Everybody was scared, panicked, nervous. We're going to have a recession. Recession. Come 2023, no recession. Right? Right? At the end of 2023, the Fed's going to start cutting rates and cutting rates. We're going to be cutting rates, at least 6 rate cuts, right? Up until January, February this year, they were saying 6 rate cuts. Now, no rate cuts, perhaps. Maybe 1 rate cut, maybe 2, but maybe none. Some people are even talking about maybe the Fed should raise the rate a base or half a basis point or 20. So the point is that they just don't know, right? I think, this is my opinion, the Fed is not going to even really strongly consider cutting rates until September because cutting rates is inflationary. When you cut rates, you incentivize people to go out and spend money, swipe the card, get the auto loan, get the home loan, ultimately, because it trickles down to the 10-year treasury when you cut the Fed funds rate. People are spending when you start cutting rates. Well, they can't afford you to start spending because the inflation hasn't gone down to where they want to see it at that 2% mark. We got a favorable reading today of CPI, right? That's the inflation number that keeps in energy and food. Got a good rating. I think it was at 3.4%. Don't have my numbers in front of me, but I think it was at 3.4% for CPI today. Just came out, right? Which is a little bit lower than what was anticipated. But still, the inflation is sticky, especially in places like the insurance companies, right? Or insurance or housing, where inflation is still high, right? So if the Fed goes and cuts those rates too soon, it's going to incentivize people to get out there and spend, and it's going to keep inflation going up or keep it the same. And it's not down where they want it to go, where it to be, right? So I think they're going to hold off on cutting rates until towards the end of the year. That's my thought process on that. Let's see here. So with all this happening, what does that say about a potential soft landing? Could be. Maybe we could be in the middle of a soft landing, right? We could be in the middle of a soft landing, right? Somebody said noted. Good deal, Curtis. I appreciate that. Take care of your debt, hold assets and cash ready for opportunities. Steve, yes. Steve summed it up right there. Take care of your debt, especially your bad debt on things going down in value. Hold on to assets that are going up in value and have your cash ready for an emergency or an opportunity. Emergency or an opportunity, right? Both things could be happening. An emergency may happen, may not, but an opportunity may be out there as well. That's why you want to hold your cash. Thanks for that comment, Steve. Very good one. Let's see here. Just running through the chat. So let me get back to what I was saying. So while the economy has shown some resilience so far, there's something on the rise that I wanted to alert you guys to, right? Oh, I forgot to say earlier, I had an article about Under Armour. They're laying off a bunch of people too. Um, but let's go to this article real quick. I want to share with you guys here. Um, so I'm going to do this. Let's see if I'm going to share my screen with you guys real quick. I like sharing my screen. It's becoming kind of fun to share my screen actually. Um, let's see here. Boom, boom. There it is right there. All right. So quick article came out yesterday or today. I'm not sure. A couple of days ago, but still want to share it with you. So in this article, guys, it talks about the fact that the consumer price index, the most watched index measurement put out by the U.S. government, declined slightly to 3.4% on a year-over-year basis. Compared with the March, boom, boom, let me go. Okay, stocks responded positively to the news. Yes, they always will. With the S&P hitting an all-time high a few days ago, NASDAQ and Dow Jones also going upwards. Indeed, some silver linings exist within the data. The latest data means the disinflationary process is back on track, right? Among the broadest categories tracked by the CPI, two of the ones most acutely felt by consumers, food and energy, hit 2.2% and 2.6% on a on a 12-month basis, which is year over year. That means they're 2%, 2.2 and 2.6% higher than last year, which is a good thing. That's pretty low, right? That's essentially in line with the Federal Reserve's 2.2% goal. But that's CPI. That's not the other core, right? Within these three categories, food at home, essentially groceries. I'm looking for the article. Maybe this is not the right article. Let's see here. Well, let me get rid of this article. The article I'm looking for, and I might have had the wrong article, but it's about consumer sentiment. Okay. Consumer sentiment. See, how consumers feel about the current state of affairs in terms of the economy, it makes a really, really big difference on how they behave with their money. So we have and we see some waning consumer confidence right now, right? We have some consumer confidence that's starting to go down a little bit, and it's reflected in some of the spending going down a little bit. And that may trickle down into why we're seeing some of these layoffs that we're seeing, because everything kind of is because how now, don't get me wrong, we still have a fairly strong economy, but there's some consumer sentiment worry a little bit based on some surveys that were recently done and reported in the last 3 or 4 days that shows that people are becoming a little bit more concerned about the economy. And when people get concerned about the economy, they stop spending. And when they stop spending, we see things like GDP go down. GDP, first quarter of this year's GDP is hovering around 1.6%, 1.6% growth at the first reading. We're going to get another reading unless we already got the second reading. I'm not sure. But in other words, GDP going down, consumer sentiment going down, spending going down, unemployment slightly going up, very, very small amounts. These are things that's happening in the economy all around us that we need to know, right? As investors, as consumers, as informed consumers, right? So consumer confidence, people are not as bullish on the economy like they may have been before. Now, experts, if you can call them experts, people that are making forecast thought processes and putting them in articles right now, a lot of them are saying that, oh, we're going to see a turnaround in consumer confidence and consumer spending as we get closer and closer to election. But here's where I caution that type of thought. When you get closer to an election, what normally happens with American people? We tend to get a little more fearful, scared, um, unsure of what's going to happen next. So when we get fearful, unsure, and a little bit nervous about what's coming next because may have a new president, may have a different president, what normally happens is people start holding their purses and their pocketbooks and their wallets closer to them. And there are experts that are out here predicting and saying, oh, economy is going to be great and we're going to actually kind of loosen up the spending and consumer confidence is going to go up in the third and fourth quarter. I'm saying slow your roll. I don't think that's necessarily going to happen because we are in an election year and tensions are high when we're in an election year, right? It might be 50% on this, 40% on this side, 40% on that side, 20% independent or whatever. And people on either side are nervous in an election year. Spending, this is why when you look at the statistics of the stock market, for instance, the stock market of businesses and business growth, when you look at the stock market, typically in an election year, the stock market is not nearly as high as it is overall on average. You don't see you see lower ROIs, you see lower interest in election years because election years are a point of contention for most people. And it may be why we see some of the consumer confidence going down a little bit. And that may continue over the next several months. And if that continues over the next several months, we could see some slowdown in spending. And the Fed keeps the interest rates fairly or relatively high where they're at right now without lowering. We could see some potential things that we need to be thinking about. Now, sounds like problems, but when you're an investor, problems turn into opportunities, right? Always be thinking about that. Let's see. I heard that too on the Fed raising rates even higher, talking about a wild ride. Yeah, absolutely. We just don't know, right? We just don't know. Some people have actually said, well, the Fed cut rates they stopped raising rates too soon, right? And I'm saying, okay, perhaps we don't know because inflation is still sticky. Very, very sticky. Let's see. I agree with you about a rate cut in September. However, I see it as a slim chance opportunity. Yep, you could be right, Curtis. If you are working, pay attention to what is being said about your company. It can give you a heads up about layoffs. Absolutely. Always read the news and pay attention to what's going on about your company and what your company, the direction of your company, etc. So, hey, check the logics in the house. Good to have you here. Let's see. Smart Money Bro, are you seeing your assets inflated? What are projections the next 5 years? Inflation and layoffs continue. I do think the stock market has been a little bit inflated. I think it's been a little bit overvalued right now. Good, bad, ugly, however you want to look at that. I think it's a little bit overvalued right now, but that's cool. Not a big problem. I don't think we're in any kind of bubble necessarily, but I don't see in terms of my assets, rental properties, real estate, I don't see them overinflated. When I look at them, I say, okay, this is a correction that was needed 10 years ago that didn't happen in terms of the real estate market, not the rental market, right? Not rents, but I'm talking about in terms of real estate and prices and so forth. Let's see. Keep sharing your thoughts on Smart Money. Hey, thank you so much. Guys, you got to do me a favor. I haven't talked about it, but do me a favor and you got to hit that like button for me. Please just hit that little thumbs up right there. Take about 2 seconds out of your time. Check the description box of this video. Lots of stuff in there. Free 24 laws of money, 24 principles that help me build my wealth from literally nothing to now something. So that's in the chat in the description box below. Also, I do one-on-one financial mentoring and coaching where I get on a call with you, do a Zoom call, and I keep that price fairly reasonable for people to afford. You can actually go to my schedule that's in the chat in the description box below, and you can go to my schedule and you can have a conversation with me only for about $50, right? If you want to jump on my schedule about your personal finances, right? That won't break your bank, but it might put a second set of eyes on your stuff, right? Which is very much needed for a lot of people, right? So experts experts believe growth in the economy should resume in the second half, right? I don't necessarily see that. I'm not saying we're headed down a bad road. I'm just saying I don't see it bumping up in the second half of this year because of the election cycle that we're in, right? So something to think about there. As an investor, some economic indicators that you should be watching right now. Not only the politics that's going on, because the politics affects the money and the money affects the politics, and it's all tied in, right? Keep up with your stock market, obviously. What's happening in the market? If you're an investor, you ought to be looking at the market, not all the time, not every day, right? But every now and then, if you are an ETF investor, or index fund investor, or you're a bond person, you don't have to look at it every single day, right? But you can look at it every now and then and pay attention to what's happening in the market. How is the stock market responding to some of these things that take place in our government, in the world? How does the stock market respond, right? That's an important, when you become a savvy, when you move from being just a regular investor that doesn't know anything about the stock market and you move into becoming a more savvy investor, this is what you're going to be paying attention to. How does the market respond to what's actually happening in the news, right? Does it respond? And you'll start seeing patterns that take place, right? When the Fed, when the Fed lowers the interest rate, stock market goes up a little bit. Because now not only can you and I go out and get loans and so forth, yes, we can go spend more money, but so can businesses. And when that business who's been looking to spend some money and go out and get a loan to go build some type of infrastructure or whatever, when they're able to do that at a lower rate, great. It's going to be a boost, right? So you just got to be thinking about the stock market. Think about the housing market too. Housing market plays a big role in what's taking place, right? And of course, the Fed funds rate, which is the rate that the rate that banks that are in the Fed system, which are most banks in America, the rate that those banks charge each other for overnight lending. Those are really short 1 week, 2 week, 3 week loans to each other. But that rate matters because when that rate goes up, right now we're still between 5.25% and 5.5%. When that rate goes up, those banks turn around and charge me and you higher interest rates for our loans, right? So the Fed doesn't just raise interest rates on all the loans. They raise the Fed funds rate interest rate, and that trickles down to short-term loans that those banks charge me and you for automobiles, for credit cards. That's why right now credit cards are 20%, 19, 20, 21, 22%, right? Because rates are higher. If the Fed says we're going to raise the Fed funds rate by 100 basis points up to 6% or whatever, 6.5, 6.25, we're going to raise that rate up. Guess what's going to happen to your credit card rates that you have to pay? They're going to be at 30%, 32%, right? Guess what's going to happen? Instead of your average car loan being between 8% and 13% right now, your car loans are going to be between 13 and 17% when the Fed raises the Fed funds rate, because now those banks have to pay more. So they're going to pass that on to you, right? But the other thing you got to think about, not just the Fed funds rate, but as a consumer investor, you got to think about the unemployment rate. That makes a huge difference. That's a big indicator to the Fed on what the Fed plans to do. I think we may see, February, we got a 3.9% reading on unemployment. I think March, we got a 3.8%. And I think in April, we got a 3.9%. So we're hovering around 3.5, 3.8, 3.9. We may be in the fours 4, 5, 6 months from now. As somebody in the chat said, whoa, government or the current incumbent president and his staff and his folks on the executive branch, they don't want that. That don't look good. when you're trying to become keep your job, right? So but you need to be keeping an eye on unemployment. And again, also, as I mentioned, keep an eye on consumer confidence. What is the confidence level? And they do these surveys. There's the Michigan survey. There's all types of surveys that go out, but you'll see it reported, in the news, on the news, in your social media feed. You got to be thinking about consumer confidence because consumer confidence drives behavior with money, right? And then, of course, GDP, gross domestic product. We got our first reading. I don't know if the second readings come out yet or not, but the second reading for the first quarter of this year is coming out soon. And it'll give us an idea of if the economy, that's the measurement they use to see if the economy is growing or if it's growing fast, if it's growing slow, or if it's not growing at all, which if it doesn't grow at all in 2 straight quarters, textbook version of a recession when that thing ain't growing at all. And the first reading from quarter one this year was 1.6 on the GDP, right? So if we get a couple of quarters in a row of a down GDP, that's considered a recession, right? So, guys, you got to do me a favor. Mrs. Moore, thanks for pointing it out. Just tap the like button. Just tap it. Take out 2 seconds, tap the like button. Come on, guys. You got to do that for me. You hit the like button, this information goes out to more and more people. You hit the like button, more people can glean a little bit of information in plain language on how this whole thing fits together and what we should be doing as regular retail investors. What this means for you, for us, layoffs, U.S. debt, inflation, right? Unemployment, consumer confidence. These are buzzwords that is used on MSNBC and CNN and Fox News and Bloomberg TV and whatever you want to call it. And they're given to you in these quick blurbs. And for a lot of folks, it takes a little while to understand that type of stuff. I'm no exception. I just happen to understand it, pass it on to you. Let's see here. Let's see. Boom, boom, boom. When would you recommend I buy a home? Count Doku. Let's see. I already have a nice condo that is paid off, but I want a home. If you're in America, tell me what city you're in, Count Doku. If you're in America, this is my recommendation on buying a home. Buy a home when you're ready to buy a home. Do not time the market when you're trying to buy a home. When you have all your ducks in a row, your debt is paid off or low. You don't have a whole bunch of bad debt laying around. You've got some emergency money, some cash. You're investing your money. You have some money saved up for a down payment for a home. Buy the home. Okay, you buy the home and you get in and you end up getting an 8% interest on your mortgage, right? Buy the home, 8%. Oh my gosh, 8% mortgage. Oh my God, don't worry about that. Okay, you buy when you're ready. And then what happens is if rates go back down to 3 and 4 and 5%, you just refinance, right? To a lower rate. If rates go up to 9 and 10 and 12%, all of a sudden it looks like 1983 and your home mortgage rates, 10-year treasury went crazy. Mortgage rates goes up to 14, 15%. Cool. You're locked in at 8%. So the point is don't try to look to when to jump in, jump out the housing market. I know you want to make a smart decision, but the smartest decision you can make is to have all your ducks in a row and buy the home when you're ready. Stop planning your life around a market that you cannot predict. There's a lot of people that said, the year 2019, I don't think I'm going to buy a house. No, I'm waiting. I'm going to wait. I'm going to see what happens with the housing market. Next thing you know, that $200,000 house they were looking at, now all of a sudden 3 years later, is $350,000. Because they was waiting around trying to figure out, should a hemming and hawing, riding the fence. Get the house when you're ready to get the house. You can always refi or not refi. Totally your choice. I hope that makes sense, Count. Let's see. NW is in the house. Let's see here. Yeah, we're getting up there, Mrs. Moore. 77 likes. Let's go ahead and push it up, guys. Hit the like button for me, right? Listen, what I like to do on this channel is I like to give you this information when we talk about the economy in plain language. Nothing fancy. Try to explain it in detail, or at least as much detail as necessary. Usually I give you a big, tall picture, not necessarily down in the weeds, because I want you to go and do a little research on your own, right? So very important, guys, that we get this type of information out to as many people as possible. If you have a question, put a Q in there. I got a few more minutes, guys. We'll hang out and talk just for a few more minutes. If you got a question, Please ask me. I don't mind answering good, solid questions. The savings is in a pay in the savings is in paying additional principal payments. Not sure what you mean by that, Joe Doe. Joe Doe? Interesting name, Joe Doe. Let's see here. Just want to make sure I didn't miss anything. So I said, what rate cuts? Um, so if you're not feeling the pinch, 84 likes. Thanks for getting them up, guys. I appreciate you more than you know. Also, I do want to mention this, guys, that on this channel, if you're not a subscriber, and I mentioned it earlier, I'll mention it again. If you're not a subscriber, please, please, please consider subscribing to the channel, because in my mind, there's a lot of channels out there on YouTube that are giving information about the stock market and all that, and they're sitting there reading charts all day, looking at the candlestick charts and looking at, options trading and day trading and all that. I don't do all that because I'm not an individual stock guy. And I know you can do some of that stuff with your ETFs and all that, but I don't really I'm more of a buy, hold, chill, look for opportunities if I want to do a little more dollar cost averaging, but I do a lot of dollar cost averaging without all the extras, right? Nothing wrong at all with the extras. One thing I am going to get into and I'm thinking about is doing some things with some options trading. I've kind of been piquing my interest a little bit on that a little bit. So there may be a little individual stock picking at some point. I don't think so, but we don't know. We'll see, right? I've got options. Options is good. Let's see. The savings in high mortgage interest rates. Not sure what you're saying, Joe. Ask the full question in a complete sentence. I might pick up on it. I'm kind of slow sometimes. I don't catch everything real fast like I should, like some folks do. So this is the deal. There may be layoffs coming. The U.S. debt needs to be addressed, right? How do you address it? Inflation sticking around, especially in housing, especially in other areas, right? Insurance. I started this whole thing off by showing you guys how the big boys do it. Warren Buffett, Warren Buffett went in and picked up Chubb Insurance 7 or 8 months ago, kept it hidden, let everybody know about it. In the last day, Chubb Insurance leaped up from trading at 252 to, I think they closed trading at 262, 264 today. 266 maybe today. Leaped up $14 in a day, right? Could have made somebody, if you had a thousand shares, if you had 5,000 shares, you could have made $30,000, $40,000 today on Chubb, right? Just because of Berkshire Hathaway revealing that they've been buying Chubb Insurance since last, August, September, when it was down around August, September of last year, Chubb was down around 180, 190, 199, right? And again, if you want to invest like that, cool. It's called coattail investing. You just jump on the coattails of somebody who's killing the game, right? Like Scottie Pippen jumped on the coattails of Michael Jordan. For those basketball fans out there, right? Just jumped on the coattails and rode it all the way to a Hall of Fame career. You could do the same thing. Jump on Berkshire Hathaway, follow what they do, jump on their coattails. Not the best, in my opinion, way to do it, but a lot of folks do it that way. So I started this live off showing you guys that information. And so if you jumped in here in the middle, be sure to rewind this thing back to the beginning so you can catch the whole thing. Let's see. The savings. Okay. Sunset on the Oceans here. Good to have you here. Put the letter Q in front. Yeah, put the letter Q in there. I'll get it. Yeah, I can see it easy. Sarah asked a question. I have a Roth IRA, and now I am supposed to invest those funds. And now I'm supposed to invest those funds into the stock market. Yeah. So what do you want to hold in your Roth IRA? Do you want to hold ETFs? Do you want to hold index funds? Do you want to hold individual stocks? What type of sectors do you want to hold? Do you want to hold technology? Do you want to hold energy? Do you want to hold communications? Right? You still have to figure all that out even when you open up a Roth, right? The Roth is just a vehicle. Now you got to figure out what buckets you're going to put in the vehicle, right? The Roth is the vehicle. Now you got to figure out what you're going to invest in, have inside of the Roth, right? Are you going to have the this 10 or 12 or 20 individual stocks and do your stock picking, or are you going to have buckets of index funds, buckets of ETFs, right? And in that bucket has a whole bunch of companies in that bucket. So you got to make that decision. If you do not, if your risk tolerance is low and you don't want to take so much risk, you want to be looking at index funds and ETFs. If you don't mind taking the risk associated with individual stock picking, go ahead and invest in many individual stocks, not just one or two companies, please, not just, Amazon, Walmart, Goodwill, that's it. No, you need to have a bunch and spread it around, right? But you got to make you have to make that decision. Okay, Sarah, if that makes any sense. Listen, I'm not going to hold you. I don't mind holding you, but I don't see any more questions. I'm not going to hold you. It's a beautiful day, beautiful afternoon, and I want you to get out there. If you haven't already, get you some walking in, get you some fresh air, get you some nature, get you a little bit of the sun, do a little sun gazing as the sun goes down, right? Or you can sun gaze as the sun rises up in the morning, right? You're welcome, Sarah. So listen, the point is this, guys. We have to be informed investors, not scared investors, not panicked investors. We have to be informed and ready with an emergency fund, ready with information, ready for a game plan of action, ready for possible opportunities that come about. What did Berkshire Hathaway do when it said, okay, late last year, we know that the cost of all the repair parts for cars have gone up. We know that all the cost of repair parts for homes have gone up. We know there's natural disasters that are happening out there. Guess what? All that means insurance is going to go up. Let's start investing these or investigating or looking at or researching these insurance companies. Chubb, or this is Warren Buffett, so he might have had a relationship with Chubb for 30 years, 40 years, who knows, right? But this is what you take advantage of opportunities. You can I like to call it dollar cost average plus, DCA plus, meaning dollar cost average. Put the money in. If you see an opportunity, put a little more money in. If you see an opportunity, put a little more money in. But the whole time, you're just putting money in, right? Pretty much the same amount unless you see some opportunities. You take advantage of those opportunities. That's what the institutional investors do. That's what they do. They take advantage of opportunities left and right. And while they're taking advantage of this opportunity and taking advantage of that opportunity, guess what? They're building wealth. That's how you build wealth. That's why when they move money out of the market sometimes and put it somewhere else. If they see that the stock market's is going to go dip, bad, and there's nothing in there to buy, they pull some of that money out long before that. They pull money out and move it around to something a little more safer. They put it into a bond that's going to get 2 or 3% while the stock market is getting -5%, right? They pull it out and put it into somewhere else while the stock market takes its hit. And while it's over there with the somewhere else, they're taking advantage of the hits in the market. So that they're working this thing all the way around. What the institutional big boy investors do. Stock market goes down, pull the money before it goes down so we don't lose money, put it in a safer investment, and then take that money while it's in the safer investment and buy stocks over here on sale. That's the game of wealth building. Right? That's the game of wealth building. It's not just trying to save your way into a high yield savings account for the next 30 years at 4%, 3.5% interest. That's not building wealth. Building wealth is a full understanding of money and a full understanding of the market and a full understanding of the effects of things that take place on the market. Housing, right? Housing, inflation, Fed funds rate, unemployment, consumer confidence, GDP, having a full understanding of how those things affect your stock market where your money is, right? Who doesn't want to know what's going on with where they got their money, right? If you take if you take $50,000, you take $5,000 and you go put it somewhere, you're going to be paying attention to where you put it. But a lot of people, they take their money, they put it in the stock market, and they don't pay attention to what's going on. They blindly invest. And then they get caught off guard and caught with surprises and not sure why they're losing so much money. And pay attention. That's all we're saying. JT Coin Rings in the house. Thank you for the super chat. Thank you so much. I appreciate you, man. Thanks for hanging with me all these years. I appreciate you being here. Let's see here. Somebody said, what are your thoughts about the inverted bond yield? I'm not a bond guy, so I don't study bonds that much. Point blank. I don't study bonds very often, so I don't really pay much attention to the bond. I pay a little attention to the bond yields, but I don't pay too much attention to the inverted bond yield or the curves and so forth. Question: I have an IRA and a high yield savings account. Is that too many accounts? Or is there something else I should look into? Happy to be here and thanks for being here, Mia or Maya. I have an IRA and a high yield savings account. Nothing wrong with that, right? You got an IRA, right? Retirement account and a high yield savings account. Nothing wrong with that at all. Is that too many accounts? No, that's not too many accounts at all, right? I think you're doing fine if you got both of those, right? IRA for retirement, high yield savings account. That's perfect. If you want more, you can do more. Or you can hang with, I would say, put your emergency fund in your high yield savings account, and anything above your emergency fund, throw it at your IRA. If you can't, when you max out the IRA, do some individual investing, right? Let's see here. When no one is buying is a good time to buy a house. Well, could be. Well, this right now is a perfect time to buy a house right now, guys, because we're going into summer months. Everybody wants to have some, depending on where you're at, people kind of want to get settled right around summertime, right? Best time to buy a house or sell a house right now. Best time to buy a house might be, or not might be, it is November, December is the best time to actually buy a house because, your competition's lower and nobody's buying houses at the end of the year, right? Right? Who's buying a house when it's Christmas, right? Well, some people are, but a lot of people aren't. When no one, okay, say, Smart Maria, you are a blessing. Hey, thanks a lot, Ava. I appreciate that. Listen, guys, I'm gonna let you go. I appreciate you being here. Listen, you can reach out to me. Leave a comment below. I will do my best on my lives to try to answer the comment section. I really do. So drop me a comment, right? Check out the free stuff that we have in the description box below. Again, free ebook, 24 Laws of Money. My schedule. Reach out to me on my schedule. If you want to do a one-on-one, check that link out in the description box here on YouTube as well. And if you want to schedule the one-on-one, you can use that scheduler. Also, in the description box, there's a few videos that you can check out that are similar to these videos, but different topics, right? If you want to learn more and dig in a little more about this information, right? And then, of course, also Mint Mobile. I haven't even talked about Mint Mobile, but I partner with Mint Mobile on my live streams. Why? Because I use them and they're solid. And if you want inexpensive premium wireless services, you can't go wrong with Mint Mobile. Solid. They use the world's largest 5G network. You ain't got to worry about drop calls and interruptions and all that. None of that with Mint Mobile. That's why I use them. That's why I partner with them. There's a link to them as well in the description box as well. Listen, as I always say, we're going to be back here on Saturday morning, 11 o'clock a.m. Central Time with another interesting, important money topic that you need to check out. Listen, hey, thank you, Sunset Ocean. Thank you, Steve M. Thank you, Mrs. Moore. Thank you, David. Thank you, Ava. Thank you, Nene. Thank you, all of you folks, for being here. I really, really, really appreciate you. Share this video. And as I always say at the end of every broadcast, guys, do me a favor. Take care of yourself. You, the physical you, the mental you, the spiritual you, take care of you. But also take care of other people. And the best person who's going to take care of the old you is the young you, the you today. Until the next video. Peace.